Today on Forbes, unprofitable microlending fintech makes big bet on global expansion. In March 2020, the COVID pandemic was beginning to devastate the finances of consumers in the Philippines. The country's government had imposed what became one of the longest military-enforced lockdowns in the world, making paying bills impossible for many citizens. Across the ocean in Santa Monica, the consequences were dire for Tala, the fintech company that makes small loans of up to $500 to low-income consumers in the Philippines, Mexico, and Kenya. Historically, 10% of Tala's customers had regularly failed to pay back their loans. That rate tripled in the second quarter of 2020. While most American fintech companies were enjoying a spike in digital transactions, Tala all but shut down most of its business, temporarily going into what entrepreneurs call, quote, cockroach mode. It had been lending out $80 million a month, but abruptly slashed that to $3 million. Shivani Soroya, Tala's 43-year-old founder and CEO, says one of her biggest fears was that she wouldn't be able to pay back Tala's lenders, which could have had disastrous ripple effects. She said she thought at the time, quote, "We have 600 people at the company. How are we going to protect their jobs?" Tala laid off 20% of its customer service staff in the Philippines and Kenya and cut other costs dramatically. The emergency measures paid off. After a year, Tala was able to return to its pre-pandemic lending levels. It raised funding in 2021 at a valuation of $800 million from investors including fellow fintech lender Upstart, Kindred Ventures, and Revolution Growth. Since then, the company has been growing steadily. Revenue is up 35% from a year ago and is now running at an annualized rate of $340 million. It has 1.8 million active revenue-generating customers. Against that background, Tala has launched an ambitious plan to double its lending by the end of 2027 through expansion to new countries, and it has new technology for assessing risk that it says allows it to safely approve more individual applicants. A lot is hinging on this. After 11 years of lending, Tala is still losing money, though Soroya says the company, quote, could be profitable at any time, if it gave up on its growth ambitions. In classic Silicon Valley style, it's betting it can grow its way to profitability, and do so in a business that is inherently risky. Soroya expects Tala will break even by the end of the first quarter in 2026. Some major fintech lenders have followed the same strategy. Affirm launched in 2013, had one profitable quarter in 2020, and just recently became profitable again in the second quarter of 2025. SoFi has a similar story, launching in 2012 and becoming consistently profitable at the end of 2023. Tala, after operating in just 3 countries for most of its history, in September entered a 4th, Guatemala. Over the next 3 to 6 months, it plans to go live in 5 more: the Dominican Republic, Panama, Peru, Vietnam, and India. It plans to do that with a rebuilt tech infrastructure that lets it make more personalized risk assessments and expand faster into new countries. When Soroya founded Tala in 2011, she set out to build what sure sounds like one of the hardest businesses in financial services to make profitable: lending money to low-income consumers in developing nations. Even though credit reports weren't available for potential borrowers and verifying their income was difficult, she devised a creative way to assess their risk, requiring access to their cell phone data and using that data, including text message receipts, to extract information such as whether people paid their bills on time and how old their phones were. Making loans of $20 to $500 to customers who earn only $5,000 to $15,000 a year, on average, is indeed a tough business for many reasons. Every loan, no matter how tiny, comes with a significant fixed cost, rendering microloans much less profitable for lenders. Investors are often leery of funding loans for poorer consumers, and such customers typically have a harder time paying back their loans. In order to make its business work, Tala has had to charge very high interest rates. For full coverage, check out Jeff Coughlin's piece on Forbes.com. This is Kieran Meadows from Forbes. Thanks for tuning in.